All right, we're almost there. I was telling my one of my in-person classes that I'm recording these videos for you guys, and this is the first time I've used this book, and I've gone from the very beginning of the book, we're almost to the end, at least of the financial accounting chapters. And I gotta say, I'm kind of worn out. Like this has been a tough process for me. So I was telling my in-class students that man, it's a grind, like learning this stuff because it's a new book for me, so I've never used it. So it takes a lot out of me learning how to teach to this book. And I can only imagine what it's like to actually have to learn this. I already know all this, so it's just a little nuance for me to move from one book to the other. But man, to have to digest all of this in a semester, it's a lot of work. And so my hat goes off to you guys. And with that said, unfortunately, this is, the last chapter, long-term liabilities, is one of the harder chapters. And then this is equally, it's probably not quite as hard as chapter 12. Sorry, chapter 10, different book, chapter 12. But it is difficult. So let's get started. We are dealing with equity in this week, right? So we're going to distribute stock in exchange for cash or assets so that we can acquire capital to run our business. And so in this video, I'm really going to kind of set the stage. I'm going to go through the characteristics of a corporation, which is kind of the backdrop of what we're the type of company that we've been dealing with throughout the semester. Okay. So learning objectives this period, identify characteristics of a corporation. I'm going to do that in this video right now. Explain characteristics and distribute dividends between common and preferred. That's definitely something that we're going to deal with in a different video. Explained items reported in retained earnings. We might get to that at some point in one of the videos. We're probably not going to spend too much time on earnings per share. I might do it a little bit towards the end, but that's not a huge takeaway of the chapter. The big takeaways of the chapter are the next three, right? So we want to record the issuance of corporate stock. Definitely, again, it's going to be a different video, but major takeaway of this chapter. And then we're going to want to deal with cash dividends, stock dividends, and stock splits. That in itself is a grind, and so that will be a different video. And then we'll talk about, man, treasury stock, right? Treasury stock is stock that we buy back, and I think it'll make more sense sort of after we talk about the characteristics of the company, and then we go into the issuance of stock. And so I'm gonna kind of hold off on what treasury stock is and why those situations arise. All right. So first thing, identify characteristics of a corporation. There's a lot of characteristics of a corporation, and we don't really need to focus on all of them, at least not in this video. But what I do like is, it's an entity created by law. Its existence is separate from its owners. And a lot of times that means that, look, if we're running a business and it's inside of a corporation, and the corporation gets sued for like hundreds of millions of dollars, we as owners don't have to worry about being liable for the $100 million. The only thing that we could stand to lose if the corporation were to get sued is our investment in the corporation. So if I contributed $10,000, but we got sued for 100 million, the only thing that I'm really at risk of losing is the 10,000. I'm not in most cases having to worry about forking over $100 million, right? Selling my kids and all sorts of crazy shit. So anyway, corporations can be privately held or they can be publicly held. In this chapter, we're all about publicly held companies, okay? We're issuing stock in exchange for cash. Okay, So again, like I was saying, the advantages of the corporation is that it's its separate legal entity, which means it has its own liability, right? Meaning that if the corporation gets sued, it can't the creditors can't come after us. Okay. The other thing that's really nice is we can transfer ownership. So I'm not sure if you've been, in fact, I don't really want to get too much into current events, but if I own stock in a business and I'm really nervous about owning that stock, I could very easily sell it in the open market to somebody else beyond the scope of this course, but it's very easy to buy and sell stock. And so we can easily transfer out of ownership in particular investments and then transfer into ownership, right? If I buy the stock of a company, I effectively own some portion of that company. And the transferable rights of ownership are pretty easy. Then the rest of them are, continuous life. A corporation is assumed to live forever, whatever. Okay, corporate taxation, right? That's a disadvantage. And what we're saying with that is if we pull money out of a business, in fact, I'm just going to do a very quick example. Let's say that a corporation has income of 100,000, right? That corporation has to pay taxes. And let's just say that for whatever reason, the taxes on the corporation were 20,000. Therefore, the after tax cash that the corporation can distribute to its owners is 100,000, sorry, is 80,000. So if I receive 80,000, right, as a dividend payment from my corporation, then I'm going to be taxed again. Let's not really worry about what the rate is or the specifics, but that's not a times, that's a subtraction. The cash that I put into my pockets at the end of the day are 60,000 because I'm taxed once up here at the corporate level and then a second time at the individual level. Okay. If it were just me and I was just the only owner, I don't have to be a corporation. And therefore, if I earn 100,000 as just a self-employed individual, right, who's mowing lawns maybe in a neighborhood, then I only have to pay taxes once, right? And so I will put 80,000 in my pocket if I'm not a corporation and only 60,000 if I am a corporation. And so, all else equal, it doesn't really make sense to create a corporation unless we're going to get all of this additional value, right? So this idea that we have limited liability, the easy to transfer ownership, it's easier to raise capital, right? There's a give and take, and that's what this slide is getting at, right? Interesting qualitative stuff, but it's not really going to be anything that we worry about um, in this chapter. And this slide is an org chart, right? So if you think about us, we're like way down here. We're way down here. However, if we buy stock in a business, we move way up the food chain. And the only way, that's just a side note, but the only way that you're ever going to get ahead in life is not by climbing the ladder, right? Not working harder and advancing in your career. The only way that you're really going to get ahead in life is if you take your cash and you use it to buy ownership in businesses. And then you appreciate or you grow your wealth as these corporations grow in wealth. You are an owner, not an employee. You could be both, right? And you're obviously not going to be a Warren Buffett or I don't know, Jeff Bezos. We're not going to own the entire company, not anything close to it, but we could take percentages of um, our wealth and convert it to equity or stock, and that's how we generally grow our wealth. Okay. All right, moving on. Rights of stockholders. Um, if I buy common stock, and we're going to get into the differences between the different types of stocks, but look, if I'm an owner of the business, I could vote on particular issues, right? I could receive dividends, and then if the company goes to shit, I could potentially participate in the liquidation of any remaining assets. That's a stock certificate. So if I buy a stock, this will be the receipt of what I own. Interesting, but not really important. Okay, if I was taking notes, right, I know that I'm articulate and handsome, right, and I'm sure many of you are mesmerized by the way that I speak, and you forget to take notes. This is the time when you really want to start taking notes, okay? So, um, our stock, we have authorized stock. So if I'm a corporation and I want to issue stock, right, I want to sell ownership in my business, I can't, like, if I'm the CEO, I can't just like decide, hey, you know what, I'm going to sell stock, I'm going to sell ownership. Because if I do, all of the existing owners are their percentage ownership declines when I increase the number of owners, right? So assume that I have 100,000 shares outstanding, and so one person owns 100,000 shares. But what if I was the corporation and I issued 1 million extra shares to somebody else, right? This individual went from 100% ownership interest in the business to like less than 10, right? His 100,000 or her 100,000 shares is now relative to the 1,100,000 shares outstanding. Okay. So we can't just do that. What we have to do is we have to go back to the board of directors, right? The board of directors is the group of like 5 or 6 individuals, maybe 10, who is making sure that the business operates in the most efficient manner, right? Meaning it makes sure that the existing shareholders are protected and taken care of. So if the corporation wants to issue stock, it has to be authorized by the board of directors. That's the first bullet point. The second bullet point is not every stock, some stock will have a par value, and we'll get to that in the next video. Some stock may not have a par value, and we'll address that in another video. Some stock may have a stated value, and again, I don't like any of this stuff, so I'm just going to move on. This is nonsense. Again, nonsense. We'll get to that when we issue stock, okay? This, again, I think I want to deal with this in the next video when we're actually issuing stock. So I think for the most part, that's the end of this lecture, okay? And maybe since I told you to take notes, let's just do one thing, okay? Where was that? Where was that? Here it is right here. Okay, I could have authorized share. In fact, you know what? We're done. I'm not doing this. I will discuss this concept that I was just about ready to go to in the video when we start talking about treasury stocks. So we're done in this video. Sorry about that.